Okay, good evening. This is Professor Mayer, and this is our 7th chat session related to controllership. It's hard to believe that we are coming to a rapid conclusion related to this class, but we are. We're going to have an interesting discussion specifically related to long-range planning, and then we're going to talk about the controller's role related to merger and acquisitions. So we're going to be covering some stuff that you probably have covered in your advanced accounting class, and those of you that have taken a tax class related to corporate taxation is we're actually going to include some specific comments related to taxation, which I think is going to be very interesting, and we're going to go forward with that now. So let's talk about the weighted average cost of capital. Now, the weighted average cost of capital is actually a very simple transaction. What I decided to do is just put a brief table together. So the brief table that you see right here essentially is what we're looking at is we are looking at our cost of capital, or essentially the weighted average cost of capital, and our weighted average cost of capital is based upon the fact that every element, whether it be debt, preferred stock, or common stock, has a cost to the organization. Now, weighted average implies that what we're looking at is we're looking at it for a pro rata distribution of the cost. The idea is that what we have in this very, very brief example, and you see it's very simplistic, but the idea is that debt, we have $10,000. The interest rate on the debt is 4%. Preferred stock, we're paying a 2% dividend, and common stock, we're paying a dividend of 3%. What does this mean? Well, the first thing we need to understand is that debt is an item that is deducted from taxes. So we need to include the tax implications of this debt. And if we assume that our tax rate is 40%, then essentially what we're going to do is we're going to take the interest and we're going to multiply it by 1 minus the tax rate. We have the 4%, and then we take 1 minus the tax rate because that essentially is the cost of the debt based upon the fact that we are now including the benefit of this of the interest expense being that it actually reduces our tax liability. Our total interest expense related to debt is less than the 4%, and we do the 1 minus the tax rate to get to the amount that we actually have to pay in our after-tax item. The preferred and common stock are not an issue, so that's not going to be an issue. So because the preferred and common stock dividends are paid after tax. So let's just to be consistent, this is going to be 2%, this is going to be 3%, okay? So this is after-tax expense. So the after-tax expense is 2.4%, 2%, and 3%. These are the numbers that we're actually looking for. So the question becomes, what is our weighted average cost of capital? Well, our weighted average cost of capital depends upon the pro rata distribution of our debt to preferred and common stock. So what we want to do is, in a very simple calculation, we are going to sum these numbers here. So we have a total capitalization between our equity and our debt of $70,000. And then we do the pro rata distribution. So the pro rata distribution is 10,000 divided by 70,000. So that's 14%. 20,000 divided by 70,000, that's going to be 28%. 40,000 divided by our 70,000 is going to be 15%. You do the sum on this just to make sure everything is together. We see that we have the pro rata distribution of debt to our equity accounts of 100%. So we simply multiply 2.4 times 14%. Something magical should actually take place. So essentially we are multiplying each of the percentages. So it's 57% times 3%. In this case, it's 29% times 2%. We add these together. Our cost of capital is about 2.6%. So round this up, and we got 3%. Okay, so actually add an extra decimal point to this, and we got 2.6%. So that's really the key that we're looking at. We're looking at the after-tax expense. The after-tax expense for debt is based upon the multiplying the interest rate times 1 minus the interest rate. So that is the after-tax piece of this. The preferred and common stock does not have an interest rate, or excuse me, a tax effect, because these are paid in after-tax dollars. Then the next piece that we want to do is we want to do a pro rata distribution of our debt and equity. And we essentially just line up these three items, we sum it, and then we do the pro rata distribution of taking $10,000 divided by 70, $20,000 divided by 70, $40,000 divided by 70, and if this formula is done right, is you add up the percentages and it's going to be 100%. We then take the percentage and the after-tax, okay, so the percentage times the after-tax. We multiply these and then we add them. So what we have down here is in fact our weighted average cost of capital. Easy calculation. The only thing you need to be aware of is the fact that debt is pre-tax, preferred and common stock dividends are after tax, so that's what we got. So let's talk about planning, long-range planning, and the role of the auditor related to mergers and acquisition. Sometimes we can get so consumed with the day-to-day activities of the organization that we forget the fact that if we don't plan long range, we're not really going to have a company or a job in the future. So we really need to understand the long-range plans, long-range goals of the organization, which really dovetails in our discussion that we had in our last chat session related to capital budgeting. Because capital budgeting and long-range planning really do mean the same thing in terms of we're moving the organization to the future. And as we're looking at the future of the organization, we're looking at it from the perspective of understanding what we're investing now, and these long-term investments are going to be hopefully bearing fruit sometime in the future. But if we're not planning, we're going to find ourselves in two specific situations. The competition has sort of eaten away and eroded our bottom line, and we no longer have a business, or the fact that maybe we are growing the business, but we are not planning for the future, and we essentially hit a brick wall or a ceiling in terms of our growth because the ability to actually move to the next level of operation is extremely difficult and doesn't happen overnight. These are the kinds of things that you need to plan for in a very long-range perspective. And it really gets down to what are the root goals and objectives of the organization. Some organizations really do plan long-term and they're investing everything into the future. They're understanding that they're doing 5 or 10 different investments. Some of them aren't going to be successful. Some of them are going to be exceedingly successful. But they have this open mind as they're moving forward in terms of identifying where they want to be based upon the successes and the failures that they're having on a day-to-day basis. That's extremely important. Frankly, hopefully you're doing the same thing with your career in terms of identifying what you do well, identifying what you don't necessarily do so well, and taking opportunities and moving forward with these. And I'll just make this comment related to your career development. It's my absolute belief that we all should be inventing ourselves on a 5-year basis. And I believe that what every one of us should be thinking about is that in 5 years, we're going to be doing something that we haven't only just barely thought of at this point in time. And as we move forward with our lives, we move forward with our careers, is you're going to have all kinds of opportunities open up for you. Well, that's exactly what's taking place within the organization. If you're looking at your day-to-day operations in a very myopic point of view, is you're not going to get it. You're not going to get the opportunities that are available to you. However, if you consider long-range planning as part of what your role is, then all of this is going to be intuitive. You're going to be seeking and seeing opportunities as they become available, and also seeing things that aren't so successful and be willing to cut the bait before things get out of hand. That's all part of the long-range goals that we have. It's part of the strategic plan of the organization. There's some theories related to strategic planning that become very interesting. What we need to understand is we need to understand where do we want to be. If in fact we reach our goals, do we have the infrastructure in place to support what we want to do? If that means that we are actually needing to invest and hire people and train and all that kind of stuff, well, that's part of the process. That's what we have to do, because you don't want to have the future hit you as a surprise. Now, at the same time, we certainly need to understand risk, and this whole element related to enterprise risk management becomes extremely critical, because there's actually one specific point that I want to sort of focus on related to enterprise risk management. And the point is that plans are terrible. Models are terrible. They're imperfect. They're never right. But they're the best that we have in terms of planning for the future. And if we don't have it, it's a disaster. If we do have a plan, we need to understand that the plan is imperfect, the plan needs to change, the plan needs to evolve, and it's wrong. The plan is wrong. But with a plan, we essentially are creating a path where we want to go. Now, a lot of the stuff is probably going to be taking place at a higher level as compared to the controller's role within the organization. However, the controller really does have a part of the process. Part of the process is that what the controller needs to be doing is to taking this information, basically digesting what senior management is discussing in relationship to the long-term plan or the long-term goals, and then developing a plan based upon these goals. Part of this is going to be what we call a pro forma financial statement. Pro forma basically is as if. So as if we meet our goals in terms of production, in terms of sales, in terms of this, that, and the other thing, the question becomes is what on the back end, in terms of people, in terms of factory, in terms of equipment, in terms of training, in terms of all of these things, do we need to add related to these resources? So when we talk about planning, we need to understand that planning is a critical element, and there is the individuals that are doing this long-range planning are probably looking at it from a very holistic perspective, and there's nothing wrong with that. You've got to sort of target where you want your organization to be. But there's got to be a person, a guy or a gal in the background that's like saying, okay guys, I get it. We get where you want to go. Now let's talk nuts and bolts in terms of how do we get from here to there. And those pro forma financial statements, which really should evolve, and frankly, as you're going through this, you're going to be looking at that financial statement, changing it, and the models are going to change basically constantly as you move closer to the goal. But again, the only way you're going to get to that goal is by doing the planning, and part of this is going to be through these pro forma financial statements. Now, the other issue is that we need to understand the financial risks and exposures. So the issue becomes is, again, kind of think about what we're talking about related to long-range planning. We're talking about long-range planning from the perspective that this is where we want to be. We want to be here. So now you're the controller, and you're saying, okay guys, I get it. I get this is where we want to be. But let's just make sure we understand the financial risks and the exposures that the organization have in relationship to this goal. If it works, the question becomes is, do we have the resources? And then the other issue is, if we create the resources, which is the only way it's going to work, then do we have the resources to sustain the organization if in fact this plan doesn't work? And this is where we're talking about related to exposures. And the issue becomes, if we shift the organization too far one direction and then forget about the rest of it, but we have all of our eggs in one basket, and if that doesn't work, then we've got a problem. And I've worked with organizations where someone comes up with this great plan, and this great plan consumes so much time and resources within the organization that we forgot our bread and butter, our cash cow, as it were, and the new plan didn't work. But because we ignored this cash cow, and the piece that really has been the sustaining force within the organization, is we lost market share, and ultimately the organization failed. Having these long-range plans critical to the organization, but we need to understand that these long-range plans will in fact create risks. We need to understand these risks, and we need to understand the exposures related to what it is that we're doing. We need to ensure that cash will be available for operating and capital needs. Keep in mind that what we're talking about here is that as we are developing the long-range plan, we need to understand that this long-range plan requires resources. Well, these are operating resources in terms of people. These are capital resources in terms of equipment and buildings and all that kind of stuff. And we need to understand that this new business will probably not break even for a substantial period of time. People still need to be paid. Vendors need to get paid. Everybody wants their money. And the issue becomes is, do we have the cash for the operating and capital needs for this project? And this is where our capital and operating budget need to come together. This is where the pro forma financial statements need to come together. And what we're looking for here is, what we're attempting to do is we are attempting to understand if in fact we have the resources to sustain what we have, as well as moving the organization to where it needs to be. And if we don't have the resources, well, we better understand that up front, and we need to develop a plan. So if we don't have the resources, this is where we are considering the weighted average cost of capital and all these internal rate of return and the present value and all that kind of stuff. Is we need to understand basically best case scenario, worst case scenario, and as we're looking at best case and worst case, we probably need to assign a probability related to these, similar to doing a pro forma or a pro rata distribution that we did on the weighted average cost of capital. We ensure adherence to bond covenants. Clearly the issue is that as we are considering options related to identifying these resources, one of the options are going to be issuing bonds or acquiring debt. Well, with bonds as well as debt, there's going to be specific covenants that we need to meet in regards to these bonds. And bondholders tend to be quite angry when the payments are not coming in. So we need to make sure that we are in compliance with the bond, because frankly, if we're not in the compliance with the bonds could be called, and we are really in a very bad situation. All of these things put together is within our pro forma financial statement is we need to understand, and again, kind of think about the basically looking at best case, worst case scenario, and various stages or various processes as we're best case, worst case, middle case, maybe 5 or 6 tracks, assign a probability to these, and then at the same time identify where we're going to be in regards to these key ratios that are important related to these bond covenants. And if we do this, then I think we're going to have a very good handle in terms of understanding where our risks are related to the bond covenants, related to resources, related to cash, and so forth. And if we do this and we see that we have a weakness, maybe that weakness is not going to show up this year, but it's going to show up next year or the following year, then we need to plan for it now so that we don't come to next year and are surprised by the fact that, oh, hey, wait a minute, we've run out of cash. This is not a good thing. So this is where the planning is, and this is where the controller's role is in terms of understanding how these pieces are actually going to work together in terms of moving to the next level. assess the likelihood of achieving the financial goals. And this is really what I was talking about in terms of identifying 5 or 6 variables, best case, worst case, a couple of middle cases, and then within each of these tracks is assign a probability, do some sort of pro forma calculation, and then based upon this is to track where we are in terms of cash, where we are in terms of the various variables related to the bond covenants, and see where the weaknesses are in terms of our planning process. And if we see too many weaknesses, well, maybe it's time to go back and review our plans. But if we see, yeah, things are going to go well, but we're going to have a couple of tough years, well, if that's the case, we need to plan for that. And the only way that we plan for that is by having someone, and since this is the controllership, someone, meaning the controller or the people that report to the controller, come up with the numbers that actually mean something as we're moving forward. And this is where data analytics become very important. This is where the budgeting process becomes very important. Understanding data within the organization, absolutely critical to our strategic planning process. So where's the strategic plan coming from? Well, it's clearly coming from the mission of the business unit. We certainly want to sustain the mission of the organization. Maybe the mission of the organization is to diversify, and that's okay. But we need to understand what the mission is in terms of moving forward related to the plan. We understand key opportunities, threats, including our risk assessment. We do this by discussing, by talking to people, by doing research, by doing all of this in terms of our risk assessment process. We need to understand what our long-term objectives are. Now you notice that what we talk about here is the mission is a very, very high-level statement. This is where we want to go. Long-range plans or long-range objectives are how we actually meet the mission. So it's kind of a lower-level tier in terms of the overall strategic plan of the organization. Then, once we've identified the objectives and we've determined, yeah, these objectives meet the mission of the organization, then we need to develop specific strategies that meet the objectives of the organization. Create a milestone schedule, again, back to the pro forma statement. Summarize financial data, sales expense, cash flow, capital expenditure plans, resources. Besides the numbers, is we want to make sure we have the right people at the right time, and these people are hired and they have the ability to actually create value at a point where they're needed. Now that becomes kind of scary because you're hiring these people with the expectation that this plan is going to work. The reality is that the plan may not work. So you're taking a risk, but certainly the person that's being hired is absolutely taking a risk. We need to understand that. And that is a part of the process in terms of meeting the objectives of the organization. Human resources, research and development, any other relevant information. Again, it's more than just the financial information. It's the resources that we need at a specific point in time so that we can meet these milestones, that meet the strategies, that meet the long-term objectives, that are all a part of the mission of the organization. Risk analysis, love talking about risk analysis. I was just at a convention today with the internal audit group. Internal auditors love to talk about risk. So what do we need to consider? Competitive response to our action. So we're not working in a vacuum. We're working in an environment where sort of kind of everybody knows what everybody else is doing. You're hiring people from your competitors are hiring people from you. You certainly insist that nobody exposes your secrets, and hopefully you have a handle on that, but in general, everybody knows everybody's business. If you are pursuing a course, chances are, if it's a course that has a high probability of success, is other people are pursuing the same course. So we need to understand that the competitive response is going to affect our ultimate success. Capital cost overruns are always problematic. I wouldn't say always problematic, but can be highly problematic in terms of what it is that we're attempting to do. Capital cost, again, not only are you dealing with vendors that may underbid with the idea that they can then bring in additional costs at the end, but we're also dealing with a situation where that we don't have a crystal ball, and it's very hard to plan these major costs 3, 5, 10 years into the future. And the reality is that in general, you can always assume costs are going to be greater in the future as compared to right now. Sales fluctuations, so we may be thinking that sales are going to be at a specific point. The fact is that it may be seasonal, depending upon the competitive situation or additional issues. These are the kinds of things that we need to consider, and this is why when we're doing our pro forma is we need to assign risk levels related to certain targets, and based upon this risk level is come up with a sort of a smoothing figure where it's not too high, it's not too small, it's kind of in a very specific place where we can deal with. But even then, you're going to have sales fluctuations, and again, sales fluctuations could mean that sales is greater than what you're expecting, which sounds like it's a wonderful thing, but if you haven't planned for that and you don't have the inventory in place, you don't have the resources in place to do what it takes to get the product into the hands of the consumers, then they're going to go elsewhere, and you basically have lost that business. And you may not have only lost it for that specific transactions, but for repeat transactions going forward. Input scarcity, again, always focusing on the resources within the organization. Cost fluctuations, this is especially critical when we're considering the resources that we are consuming in terms of manufacturing and other areas, is we want to understand how these resources, how we can plan for these resources in terms of costing. We may in fact want to create some sort of hedging strategy related to purchasing these resources, although that itself is going to create risks. But we certainly understand that these are the kinds of things that we need to consider. Political risk, nationalization, regulatory, environmental, tax issues. This is especially true when we're considering working in an international environment. Working in an international environment can be very profitable and very good for an organization, but we need to understand is that in a international environment, the number and the nature of the risks increases substantially as compared to working in a single area. So we need to understand this, and there's things that we don't consider at all in the United States may in fact be significant issues in other countries. Reputational issues, so if we fail, everybody's going to know about it, and then the other issue is you may in fact be moving in a very specific direction, and technology changes that changes everything in terms of what's taking place. Well, sometimes you can't foresee this, but you need to be nimble enough in terms of being able to be in front when these technology changes actually take place and understand the implications of these technology changes related to your organization. Talking specifically about the role of the controller, it's indirect as units develop. What we're doing is we're forming the analyses, and again, we're kind of the back end piece as the controller. Is a lot of the things we talked about in terms of strategic planning is going to come from a level higher than the controller. But it's the controller that's providing data for analysis, that's actually conducting the analysis, and for the most part interpreting the analysis and helping people understand that as they're developing these strategic plans, is these plans need to evolve need to change. The worst thing in the world that you want to have happen is that senior management is dead set related to this is where we want to go, this is what we're going to do, and the numbers don't necessarily tell the story that this is going to be successful. One could argue that these are the opportunities for tremendous successes, and I'm sure you could come up with some examples. This is the starting point for potential disasters within the organization. So we need to understand this, and we need to understand the data and the analysis and how this analysis should be used by management in terms of setting their goals. And again, the goals are related to the mission and the goals are related to the strategy. So it's all working together. We are a key element related to the risk assessment process, and what we're attempting to do is to consolidate individual plans into our consolidated statements. And we're talking more than just consolidated financial statements when we have an ownership of an organization. What we're talking about is all of the information that we have. And there's a tremendous amount of information out there. And this tremendous amount of information basically could be an information overload to management. We need to be able to consolidate the information in such a way that we're able to tell a story with this information, an objective story. And we want to make sure that we're not cherry picking the data to come up with information that proves or disproves what we believe is going to be the case. But what we're looking for is we're looking for an objective assessment and a consolidated assessment in terms of providing the information. We are evaluating the plans, assisting, and then we're providing suggestions to improve the plan. Clearly, as we are looking at the resources, and we're really the only ones that have the data and the expertise and the knowledge of the organization to determine what resources that we need, is as we're going through these plans and we see weaknesses, we can certainly say, okay, well, this isn't going to work because of this. What we should be saying is what we recommend to address the issue that we see that's coming up in 9 months or a year or 18 months is to do this. And this is basically our role in terms of guiding the process, but we're guiding the process, you see here at the top here, largely indirectly as these units develop their plans. So we're not running the plan, the strategic planning, but we're certainly a critical element related to this. Let's talk a little bit about mergers and acquisition. We have just a couple of slides here. It's actually kind of some interesting information. In your advanced accounting class, we talk about mergers from the accounting perspective. So basically, as you recall, whenever we acquire greater than 50% of an organization, we are then going to consolidate these financial statements as part of a consolidated financial statement. And we go through this process in terms of marking to fair value the assets and liabilities, and going through this worksheet where we are basically identifying the fair value, the book value, the excess, and identifying items that have depreciation and so forth. And you remember all the stuff in most fun class that you've ever had, and that's the accounting piece, and that's a piece of it. But we also need to understand that merger also entails tax situations, and in fact, one of the things that we need to understand related to the tax situation of a merger is that the tax situation in many cases is going to guide how an organization or how two organizations are actually going to merge. And we'll talk about that in a few minutes. And one of the things that mergers and acquisition, very critical topic in terms of accounting and taxation and law, is that if you really want to understand the process, you want to understand it from the perspective that there are accounting implications, there are tax implications, and there are legal implications. and it's very difficult to look at it from a single process. So I think what this class does is introduces some additional elements, and hopefully as you're going through your classes, you're taking some corporate taxation, some business law, to really have a much broader perspective related to this. So we need to understand the process, the due diligence that we have to do, that we're going to be guiding this, identify valuation issues, and then we're going to talk about specific types of mergers. So an acquisition is a buyer acquires all or part of a business and both parties cooperate in the transaction. And again, from an accounting perspective, a merger is where we're acquiring more than 50% of the organization. A hostile takeover is where the target company is not interested in being purchased, but we in fact acquire the stock through various means. And then a merger is two companies become combined into one. After the merger is essentially there's no distinction between the two specific companies. Overview of the acquisition process. Buyer contracts the target to express interest. They exchange information, non-disclosure agreement, offers are made, negotiations commence. If accepted, the buyer issues a term sheet, letter of intent, non-binding summary of the primary term. We'll talk about due diligence in a few minutes, but we're going to negotiate the price. What we're going to do is we are probably going to get a fairness opinion. Now, what is a fairness opinion? Fairness opinion is where we have someone come in, consider the transaction, and basically provide an opinion that this appears to be a fair transaction. Why is this important? Well, this is important in terms of our due diligence, where that if something goes wrong, is we can always say, well, you know what? We had someone look at this transaction, and this individual indicated that this transaction was a fair transaction. It's more of a protection to the buyer as opposed to really anything else. Shareholders may need to approve this transaction. It's very possible that we may need governmental approval depending upon the competitive nature of the organization that we are acquiring. Then the issue then becomes is how do we actually get these two companies to actually merge in such a way that there is integration in terms of the two organizations. One of the difficulties that occurs is the fact that you get these two companies to merge, but the reality is that there was never any integration in terms of goals and objectives and all these things within these two organizations. If you're not doing this integration correctly, we're setting ourselves up for failure. Okay, hostile takeover, you probably aren't going to be thinking about integration here, but we are attempting to go directly to the shareholders to take over the organization. It's more expensive because we're essentially convincing shareholders to disagree with management and sell, and the reason they're selling is because we are buying at a premium. This is typically a situation where it's more risky since we don't have targeted company's internal information. And then the other issue is the fact that executives within the acquiring company are probably going to have some sort of golden parachute that essentially creates an environment where it becomes very expensive to the acquiring company to acquire this company. And from the executive's perspective, it's actually very profitable for them. So they're basically walking away with a pot of gold. Well, someone's going to pay for that. More risky because we don't have access to information coming from the target company, but there must be a reason why we are attempting to do this takeover. Due diligence, controller plays an important role here. Is what we're doing is a detailed analysis performed after the agreement is reached. We identify unusual risks, verify the financial statements. We're going to determine opportunities to jointly increase revenues and decrease expenses. So we are one of the key elements related to a merger that from a corporate perspective is a good thing. It's not so good for the employees, but we're able to go through both organizations and determine where there's duplication and streamline the operation. This is one of the problems in terms of integration, is people kind of view this as being, okay, well, you may be nice to me, but you're doing this and you're going to end up taking my job. This is something that we need to consider very seriously in terms of how we actually integrate the operations in such a way that we can maintain morale and maintain productivity and integrate IT systems and all this kind of stuff, but it becomes very, very difficult. Determine opportunities to jointly increase revenue and decrease expenses, other due diligence issues, organizational culture, employee morale, kind of like what we're talking about here, compensation plans. As we are acquiring these organizations, there's going to be various forms of our pension programs and health plans and all these things. And all this stuff needs to be integrated. Clearly, human resources is going to be a key component of this process. We need to understand what the intellectual property is, who owns it, how it's owned, and frankly, one of the things that we want to consider as we're acquiring this company is, are there components that actually now can become assets, these intangible assets that we're actually reporting as part of our balance sheet? Human resources, IT, we understand fixed assets, the accounts receivable quality, inventory, all really important stuff, and stuff that understanding accounts payable, tax forward, carry forward, unrecorded liabilities, debt terms, especially our covenants, revenue and expense trends. The controller is probably going to be developing various pro forma statements in terms of moving forward. One of the things that we clearly understand is in a merger is that we are valuing assets and liabilities of the target company to fair value. We are identifying our unrecorded assets and liabilities. Then ultimately we're going to identify our goodwill. So this is where the controller gets involved in. We want to identify fair value using multiple methods. We want to identify the fair value of the organization using the stock price. There is a multitude of revenue numbers, including EBITDA or some other figures, enterprise value. When we are measuring fair value, we're probably going to be using some sort of consultant related to this, but it's going to be a discounted cash flow, free cash flow for 5 years, terminal value, discounted rate based upon weighted average cost of capital. Whatever method is used, we need to develop a sensitivity analysis for this. In other words, we want to identify, very similar to what we were talking about before, is if some of these variables change based upon risk, how is this ultimately going to affect our fair values? Earned outs are becoming more common. And now what we want to talk about is the types of acquisitions. There's 3 criteria. And again, this is where the tax information comes in. And I see we're running out of time, so we'll get to this very quickly. The idea is that in an acquisition, the goal would be, theoretically, is to make this a non-taxable transaction to the sellers of the company. The acquisition must have a bona fide business purpose. There is a continuity of interest. The buyer pays at least 50% with stock, and a continuity of the business enterprise. So with this, there are 4 types of transactions. There's a type A transaction. We call this a statutory merger. What we're doing here is the seller essentially is acquiring stock. This is a non-taxable transaction. We're essentially deferring taxes to a later date. The selling entity is liquidated. The buyer remains intact. The buyer dissolves. A new entity is formed. This is merger versus consolidation. We transfer all liabilities, all assets and liabilities to the buyer. We can use tax, but we must meet the continuity rule related to the tax-free status. The cash part is going to be taxable. So both boards and selling shares must approve. So again, what we're talking about here is, to the extent that stock is used, this is a non-taxable event for the seller. To the extent that cash is used, that is going to be taxable. In a type B merger, this is stock for stock swap. The buyer pays nothing but voting share to the seller. Buyer must gain immediate control, although there's a creeping control that's allowed over a 12-month period. There is no need for approval. In a type C transaction, this is a stock for asset swap. Must transfer at least 90% of net assets, including all critical assets. At least 80% of the purchase price must be voting stock. Piece that is non-stock, that's cash, that's going to be taxable. And the descending shareholders can have ownership portions appraised and then paid in cash. Type D transaction is a cash acquisition. It is taxable to the seller. So we actually completed this minute after 9 o'clock. We will have our next session in 2 weeks. So I thank you very much for your time.